We keep hearing on YouTube the same advice. Taxes are going up, so you should convert everything right now to Roth. And maybe it sounds smart, except I've seen people accidentally create tens of thousands of dollars in hidden taxes and Medicare costs by blindly following such advice. Roth conversions can absolutely be powerful in the right situations. But retirement planning is usually much more nuanced than just that one strategy. Because a Roth conversion affects not just taxes, it affects Social Security taxation, Medicare premiums, capital gains tax opportunities, withdrawal strategies, survivor planning, and long term retirement flexibility. So, in this video, I want to walk through several factors that could make Roth conversions much more complicated than most people realize, even if future tax rates eventually do rise. And not because Roth conversions are all bad, and not because taxes won't potentially increase later, but because the real question is rarely, will taxes go up? It's actually more around how does the conversion affect the rest of my retirement plan over time. Hi, I'm Chris Knight with Cornerstone Wealth Planning. I'm a certified financial planner and fiduciary advisor, and I've helped hundreds of clients over the last 20 years make wise decisions related to tax planning and Roth conversions. One of the biggest things that we help clients navigate is how retirement tax decisions interact with other parts of the plan: Social Security, investment withdrawals, healthcare costs, estate planning, and long term retirement income strategies. Any point during this video you'd like help evaluating whether Roth conversions make sense in your own plan, I've included a link in the description where you can schedule a complimentary call with our team. Okay, let's start with one of the biggest misconceptions surrounding Roth conversions. Number one, understanding current versus future tax rates. One mistake people often make with Roth planning is assuming it is a very binary decision. Are future tax rates higher? Then you should convert aggressively. If they're lower, maybe not convert. But retirement tax planning rarely works that cleanly. The comparison is not simply what tax rate exists today and what tax rate exists later. It's more about what taxes would you pay now versus what realistically would apply later after considering all the side effects. For example, someone may convert a large amount in one year because they're worried about future tax rates increasing, but that conversion could also push them into higher Medicare premiums and impact Social Security and other areas that they were not even planning for. So someone could convert this large amount in one year because they were worried about future tax rates that would increase, while they actually ended up causing a higher tax bill between the couple of years overall by doing so more blindly. So yes, future taxes may eventually somewhat be higher, but the upfront cost of the conversion itself may also become far larger than expected. And this is why Roth conversion planning often works much better when it's gradual and when it's coordinated instead of being aggressive or reactionary. This is especially important during lower income retirement years. For many retirees, the years between retirement and when the required minimum distributions begin could be valuable planning years to consider because income may temporarily be much lower. So Social Security may have not started yet. Your portfolio withdrawals are still very flexible from where you're going to be pulling from. And in some situations, these years create opportunities to strategically fill lower tax brackets without unnecessarily pushing income too high. And that's a completely different strategy than simply convert everything. And before we continue, if you're enjoying the video so far, do me a favor, hit the like button. It really helps this channel reach more people approaching retirement who are trying to make informed financial decisions. Okay, the next issue retirees often overlook is how Roth conversions interact with Social Security itself. So number two is understanding Social Security taxation with Roth conversions. Now this surprises people all the time because many retirees assume, well, Roth income is tax-free later, so this should simplify my taxes. But Roth conversions themselves still count as taxable income in the year in which the conversion occurs. And that matters because Social Security taxation is based partly on something called provisional income, meaning larger Roth conversions can cause more of your Social Security benefits to become taxable today. In some situations, up to 85% of your benefits may become taxable depending upon how your income stacks together. So now the conversion isn't only creating taxes on the conversion itself, it may also create additional taxable income from Social Security benefits that you weren't expecting. And this is one reason effective tax rates during retirement can become much higher than people initially expect. And this is where retirement planning starts becoming so interconnected because Roth conversions are not separate from other planning items like Social Security timing, your withdrawal strategy, your income needs in retirement, or those future required minimum distributions. All of these pieces affect each other. And one of the first things that we typically evaluate is simply looking at what does your tax picture actually look like, not just this year, but over the next 10, 15, 20, or 30 years in retirement. So instead of only looking at the current year in isolation, let's understand our long-term tax outlook over a lifetime. Because sometimes these smaller, more measured conversions create much better long-term outcomes than one large, aggressive one. Now, another area where precision becomes incredibly important is understanding the overall Medicare cost. So, number three, your Medicare premium thresholds. This is one of the most overlooked retirement tax traps. Medicare IRMAA surcharges. In simple terms, higher income can trigger significantly higher Medicare premiums, and Roth conversions count towards that income calculation. Now, what catches many retirees off guard is that Medicare uses these income thresholds. So it's not a progressive system, it's actually where you cross over even one threshold by a relatively small amount. And it means that your income could cause these premiums to increase significantly very, very quickly. So, in certain situations, this conversion that initially appears beneficial could have a overall ripple effect that affects many different things, increasing premiums meaningfully and causing other items such as higher Medicare costs, higher Social Security taxation, and fewer tax planning opportunities in other areas. And that completely changes the math overall. So, this is one reason Roth conversion planning often requires much more precision than generalized online advice would always suggest. Sometimes it absolutely makes sense to convert larger amounts and do it aggressively, but other times, stopping just before a Medicare threshold may create a far stronger long term outcome. So, again, the goal is usually not maximizing one individual planning strategy, it's actually improving the efficiency of the entire retirement plan as a whole. Now, if you would like help understanding how your Roth conversion strategy may unintentionally create future tax or Medicare problems, there's a link in the description where you can schedule a complimentary call with our team. Now, let's talk about another planning opportunity that large Roth conversions could sometimes disrupt. So, number four, think about capital gains in your non qualified or brokerage accounts. So, these are not IRA accounts, but other taxable accounts, investment accounts. This is another area many retirees may have never heard or discussed. In certain situations, retirees may be able to realize long term capital gains at a very favorable tax rate, potentially even 0%. Now, especially during lower income retirement years, this could occur, but large Roth conversions can use up that tax space, meaning retirees may lose opportunities to harvest gains efficiently from these brokerage accounts. And this is where asset location starts to even matter and be important because two retirees, identical portfolio balances may need completely different Roth conversion strategies depending on a number of items as it relates to the investment. So, where are the assets held? what type of accounts, how does the income flow through retirement, and what does the future withdrawal needs look like. So someone with mostly pre-tax retirement accounts may require a completely different strategy than someone with substantial brokerage assets or Roth balances available. Now, this is why retirement tax planning becomes much more personal than generalized, and that oftentimes we don't catch with just the average internet advice. So the strategy depends heavily on the structure of the overall entire retirement plan, not simply whether future tax rates increase. And finally, there's one additional layer that most people overlook completely. So, number 5, very important, understanding beneficiaries, estate planning, and long term flexibility. And this is where Roth planning becomes especially nuanced because inherited Roth accounts can be extremely tax efficient for long term beneficiaries. And now, in some situations, retirees intentionally choose to pay more taxes during their retirement so there's less taxes for their beneficiaries to pay long term. And for certain families and situations, this can absolutely make sense, especially for higher net worth households focused more on leaving and legacy planning. But it's still important to evaluate this trade off very carefully because sometimes retirees aggressively converting assets only to reduce their own flexibility, reducing their own spending capacity, or even reducing retirement confidence in the process. Meanwhile, the primary tax benefit may not actually end up for their heirs and beneficiaries until decades later. Again, that doesn't make the strategy wrong. It simply means that the strategy needs to be truly intentional. And at Cornerstone Wealth Planning, we regularly evaluate this for clients. We help understand who actually benefits from the conversion, when the tax benefit realistically will occur, and whether this trade off improves the long term retirement strategy overall. Because retirement planning should support both long term efficiency and quality of life during retirement itself. So, if you're trying to determine whether Roth conversions make sense, here are the major areas to evaluate. Number 1, tax brackets today. Number 2, future projected income and tax brackets down the road. Number 3, how it impacts Social Security taxation. Number 4, understand your Medicare premium thresholds and if that's going to affect those. Number 5, capital gains, tax rate opportunities. Number 6, withdrawal strategy flexibility. And then number 7 and number 8, understanding the required minimum distributions, affecting your tax rates later, and then this estate and survivor planning for your beneficiaries and those that will inherit your assets. And now, most importantly, let's not lose the broader point that how the conversion affects the overall retirement plan instead of seeing it just as one isolated tax variable. Because once those pieces are evaluated together, the right conversion strategy usually becomes much more clear. And sometimes aggressive conversions create enormous value and they make a lot of sense for someone to do. But other times, these smaller conversions, doing gradual bracket management as it relates to taxes, or even delaying conversions entirely, could produce stronger, longer term outcomes. So the key is simple, it's coordination and integration. It's not internet slogans, it's not memes, it's not fear about future taxes. And it's not assuming that every Roth conversion automatically improves the plan. So if you'd like help building a personalized retirement tax and income strategy around your Roth conversions, your Social Security decisions, your withdrawals, investments, and long-term planning, then real simple, click the link in the description where you can schedule a complimentary call with our team. We've helped people do this for years, and we've helped people make these decisions that are integrated, proactive, and cohesive around what is important to them. Thanks a lot for watching. I'll see you in the next video.